lot of volatility in the space, being very choppy. And obviously when you have tariffs, people start worrying about a slowdown in global demand for oil. So that really had a very negative impact on the price, and you saw that in April. And then OPEC sort of kind of piled it on when they decided that they're going to bring back a lot of the cuts that they had enforced throughout 2023 and 2024. And they said, you know what, we're going to ramp up this production again. And then you saw oil sort of really take a bath around that time. Since then, it has recovered. A lot of the thematics around tariffs, people realize that maybe there's an off-ramp, maybe there's some deal work to be done. Maybe the picture doesn't look as bad as we thought. So you saw it come back up a little bit, as well as the OPEC. People realized that even though there is supply coming on in the market, what's happening is that every time you cross $60 a barrel on the downside, US shale slows down, production goes away. That helps. And on the other side, they realize that the actual production being added to the market is really not as much as promised, right? So these factors really help kind of bring it back up. And then you saw it recently with the tensions again being escalated in the Middle East, the conflict really getting a new sort of dimension to it with missiles being exchanged and what's going on right now. And obviously there's a lot of fluid movement still, exactly what's going on there, but we'll see how those things develop. Unlike oil, where you're sort of in a mildly oversupply scenario, natural gas has sort of been the opposite. What you've seen is two big thematics going on. First of all, the ramp up of US LNG. Natural gas, unlike oil, it's hard to ship, right? So the way to ship it is you compress it, liquefy it, and you put it on containers, which is essentially what LNG is. So that really opens up the global market. And the United States has been doing that. So they have been more than doubling the capacity over the next 3 years, right? So when that happens, you're essentially driving a lot of demand for natural gas. And the other thematic has been AI and data centers. A lot of power being added, a lot of coal replacement. So these two factors have really been playing in the natural gas market. So natural gas prices have been steadily going up. So you're actually in a scenario where demand is pulling you, as opposed to the oil markets where the supply is already there. Especially in the key markets here in Canada and the US, where you have a lot of cheap natural gas available, I think it makes sense to be able to sort of look at these equities and say, okay, there's a huge demand pull there. On the oil side, it gets a little bit more tricky, right? Because you're looking at a price environment that's not necessarily conducive to valuations improving, but you've seen this now where you can have a tension escalating in the Middle East and all of a sudden supply disruption becomes a very real threat and prices rally. But on the whole, on the oil side, I would say it's really important to look at the quality of resource. I think a thematic that has been emerging in the US over the last couple of years really has been resource duration. So you're seeing essentially the maturity of shale, and you're going to start seeing some decline come into the US production, right? So that means that the companies that hold valuable acreage are even more valuable now than they used to be. And over time, the companies that actually have the better rocks will really differentiate themselves. So that's where you want to be. In Canada, I think we're blessed because we already have a few companies that have a lot of duration. In this US, I think that you have to be more selective.